US GDP growth is expected around 1.6% this year, picking up a little bit into next year. That's, of course, if it's all business as usual and we can resolve the debt ceiling issues, get government back to work. Those are the kinds of numbers that we would expect. But it's a slower level of growth, although it's positive. If anything should impact that, if the government should default on their debt and we had a dramatic increase in interest rates, markets as well would respond negatively. That would reduce the wealth effect. We would just reduce demand completely. That would impact the rest of the world, as well as the major trading partners of the US. But we've seen warnings out of the IMF just generally that the global economy has been advancing at a very slow pace. And in developing markets, a lot of them have to get their fiscal house in order. And that's a situation that we have in South Africa as well. So with this impact of a slowly growing global economy, as well as this tightening at home in each of these developing economies, that's hurting growth prospects. And our own economy, very much in that same boat, running budget deficits for a number of years. We'd like to get that back to a surplus, or at least balance the books at some point in time. But in that environment, we're looking at a slow rate of growth, probably around 2% this year, picking up potentially to 2.8% next year. Big debate raging at the moment about what is our potential growth rate. The Reserve Bank seems to think 3.5%, or the market even seems to think 3.5% potential growth rate is even too high, given our current structural problems, our labour issues, our big budget deficit, our big current account deficit. So lots of work to do, and we look to that medium-term budget policy statement for some direction where we can get some fiscal stimulus while at the same time trying to close that budget deficit in light of the monetary policy stimulus and these decade-low interest rates that we currently experience.